Welcome back to the IB Investor channel. In this video, we're going to cover Vitec Vertical Software, which is a Swedish compounder. We'll cover a short introduction of the company, the share price development, the sales and profitability, the cash flows, the debt situation, the return on invested capital, return on equity, the dividend yield, and its history. Vitec was founded in 1985. The company has a market cap of 17.8 billion Swedish kroners. It currently trades on large cap under the ticker symbol VIT, and it's the B shares that are listed here. And the industry is within IT services. Vitec is a leader in vertical software and has its origins and headquarters in Umeå, Sweden. Vitec develops and delivers standard programs for various functions in society. This is at the heart of a variety of the businesses such as pharmacies, banks, car repair shops, real estate, healthcare, and education. They have more than 38 business units, and most of their programs or systems have recurring revenue. So that's probably something very close to a subscription-based model that, for example, Spotify uses. But I would just assume that these kind of businesses have much higher stickiness. You can't just, change the system in a matter of seconds, but rather, it probably demands some sort of project to even change these systems. So for that reason, I think it's probably a little bit more sticky than just, canceling the subscription and you're done or out. Now for the share price development here, and we can see that the stock has done very well for itself. So for the maximum period here, we can see that the stock has returned a 2,200% here. However, in the most recent time here, we can actually see that most of that return has come from, the past few years here. So if we look on the right side here, we can see the total return here for the different periods. And the total return, just as a reminder, that's when you've received some dividends and actually reinvested those dividends into more shares. So for 1 year period, 13%, 3 year period, 55%, 5 year period, 461%. So this number starts to get pretty massive here. And for the 10-year period, total return again, 2,734%. So quite a massive return here, or total return here for shareholders here holding the stock for the long term. We can also see here at Diversified that the company currently has 7,619 shareholders, so not the most commonly owned share here, but quite a few at least. And we can also see here that the short positions for this company is quite low at 0.79%. Now for the net sales of this company, and the net sales here in blue has grown pretty nicely, and we can see there's been absolutely no declines, but rather just upwards here. And we can see that it actually picked up some speed here from 2022 to the most recent quarter here, which looks very, very good. We can also see the EPS here, which is a little bit more volatile here, going up and down compared to the net sales here. So, but at least here in the most recent time, they have increased the EPS by quite a margin, I would say. Looking at the gross margin, speaking of margins here, 88.2%, which is very respective. So this is certainly a pure software company. But we have seen here, though, in 2022, that the company did have a gross margin here exceeding 100%, which is kind of strange. I've never seen that before, actually. But then again, I'm not too experienced with a lot of software companies. But I would just assume that it's because of the business that they're in, that the software perhaps is not associated with any, costs of goods sales in the same way that maybe an industry company is or something like this. If you know this reason, maybe you can comment this in the comment section and educate us all. But the number here is above 100% at least. But I would just assume it's something to do with this being a software company. Software companies, when I looked at some in the past, that have produced some crazy numbers, it's often the case that it just doesn't cost anything to add more copies of the software. And maybe that's the reason here. I'm not sure. Anyways, the profit margin here 12.5%, which is very healthy. So nothing wrong here. It has been a little bit higher here in the past. So in 2022 they did, or sorry, 2021 they had recorded a 13.2%. So it's been higher in the past, but a 12.5% profit margin for any company is good. But I would have assumed perhaps for this being a software company with really high gross margins that the profit margin would have been higher. But yeah. Continuing here with the sales, so we have the sales here broken down by business unit and its customers. So here we can see the countries, and when we look here at the pie chart, we can see that no country amounts for more than 50% or something like this. Sweden is the biggest though by 25%, but we can see that it's quite diversified here between different countries here. And Norway being the second biggest here, it looks like by 19%, and then it piles on, but quite diversified in terms of geographies. Now looking at the largest business unit that they have, it only accounts for 12% of net sales, not 50, not 30, but 12% of net sales. So again, quite a low figure here, which is good for the diversification here. And we can also see here that the 10 largest customers here amounts for only 9% in total of net sales. So again, they're also diversified here in terms of their customer base. So if one of the customers, or 10, let's say that 10 of the largest customers will leave today, they would lose about 9% of net sales. So obviously a big hit, but it's not worse than that. Now for the share count history of this company, and we can see that the company did start here 10 years ago with 28 million shares here, but during the period here we can see that the company has issued some shares over time here. So here in the most recent quarter they had 37.5 million shares, so that's a growth of roughly 33% from this period to this period in terms of dilution here. So this company has diluted the shareholders, and I would assume that it's because they probably used some shares here in terms of equity when they acquired some other companies, I would assume, because this amount of shares, share dilution, I would just assume it's too much for being just stock-based compensation in itself. So I would just assume when I look at this that they used some shares here for equity and some acquisition. But overall, me personally, I don't like when companies does this because it just dilutes the current shareholders, and management who uses the shares as equity often diminishes the shareholders. But this is a negative part from my side. I'd rather see this picture being the other way around, that they have a share reduction instead, that the outstanding shares are being reduced over time instead of increasing. Now for the free cash flow margin and the per share, but beginning here with the margin here, we can see that the company is actually producing a negative margin here, which is not very good when looking at this from the sidelines. I don't know that much of the company, but we can see that for the long period here, the company has only produced almost negative cash flows, with one exception here being in 2020. So yeah, doesn't look very good, and we can also compare it here with some peers. Fortnox actually being pretty low here, 0.4%, and Cint Group here at negative 0.9%. So even the peer group here is actually performing quite bad. Looking at the per share, it pretty much paints the same picture here with a negative free cash flow per share here in terms of kronor. So in the most recent quarter here, trailing 12 months, we can see negative 20.6 kronor here. And again, this number here, the 2020 number here, 3 kronor, which is the only time that they actually posted a positive free cash flow per share here for the 10-year period. Now for the cash flow overview, and we can see that the cash from operations here in blue has grown pretty nicely over time. So posting a 801 million Swedish kronor here for the most recent quarter, rolling 12 months. However, we can see in 2020, they almost doubled this number here in the most recent quarter compared to that of 2020. So very good growth here. However, I would say the only negative thing here is actually the investing part. So they have far overinvested in terms of comparing it to the cash from operations here. So big gap here between those two, and it's going to be interesting to see how they finance this, because I would assume that they had to acquire more debt in order to grow this much, because we can see that they have put a lot of money here in orange in capex for the investing side of the business of 1.5 billion, 1.4 billion, 1.6 billion almost here for the past few years, which is very, very high. And also we can see here how the free cash flow has been affected as a consequence. So massive negative here for the past 3 years. However, it's been reduced a little bit here, but it's going to be interesting to see on the next picture here how the net debt has developed as a consequence from this, because the cash flows aren't that strong as it looks like right now. So now for the net debt versus the cash from operations, and this pretty much supports the other picture that we just saw, that the net debt here in blue is ever so increasing, and we can see here a massive change here, almost doubling from one year to the other. So going from 916 million Swedish kroners up to 1.7 billion Swedish kroners almost. And we can see that the cash from operations are following, but we can see here that the gap between the cash flows and the net debt here is increasing massively here from year over year here. So this is not a good sign. However, they can still pay off, all the net debt here with, 2.5 or 2.1 times in terms of years here. So it's not that crazy right now, but I don't like when the gap is increasing like this. It just shows that, management has probably gone out on an investing spree here, either acquiring a lot of growth or investing in their own businesses, and doing so by acquiring more debt here, which we can see here pretty clearly. Now for the net debt to EBITDA, and we can see that the company currently has a 1.7 times multiple, so it is actually the highest here, for the period measuring here. So we can see that the company has been lower here, 0.97 for many years here, around that figure, but this is quite a big jump here from 1.2 going to 1.7, and especially here from this period, 0.9 going to 1.7. So, this also supports the previous picture, as we saw that, the debt is ever so increasing here for this company. So it could be alarming if this numbers keeps on growing, but as for now, a 1.7 multiple in itself is not alarming. So the interesting part here to see whether or not this number here grows or not in the coming quarters. Now for the enterprise value to EBIT, and we can see that this company is quite expensive here, a 35 times multiple. However, in the past, it's actually been more expensive here, topping here 54.3 times multiple here, which is very high, but it has been as low as 14.8. So this is a much better value proposition, but obviously the company was smaller, probably less diversified than it is compared to today. But I think it can be good for investors and speculators here that this company is not cheap when looking at the enterprise value here to EBIT, at least. I mean, I wouldn't necessarily say that the company should be cheaper, but it is a software company after all, which probably dictates some higher multiples here. But you could be getting Evolution at below 20 times at this point. So I think Evolution Gaming and this company has some similarities when it comes to at least being software businesses, but obviously in very different businesses. But I think that this multiple, as it is right now, looks pretty expensive, but then comparing it to the past few years, this is actually a much better value today than 2019, 2020, 2021. So depending on how you look at it, if you look at it at most recent time here, it's much cheaper today, but going back, almost a decade here, then yeah, it's much more expensive. So it depends what kind of time horizon here you would reference the company for. Now for management's allocations performance, and this actually caught me a little bit off guard because I thought that the numbers were quite low. So on the left side here we have the return on invested capital, and we can see that it currently sits at 5%, which is quite low, but it hasn't really been 20%, 30% in the past either, but rather the max here for this period was 15%, and that's not so impressive. So the allocation here from management hasn't really been that good for driving profits here. But looking at the return on equity, it's a little bit higher here. At least in the past, it's been almost 29% here in 2015. But looking at the recent time here, even return on equity has been quite low here at 9.4% and as low as 7.6% here in 2022. So quite surprising numbers, I would say. I would have expected management's numbers here to be quite a lot higher actually compared to or these numbers. So yeah. Now for the dividend side of the business. So on the left side here we have the dividend yield, which is quite low here, 0.49%, and it has been higher here in the past, but we can also see here in the payout ratio that the company did pay out much more of its profits here in 2014. So, even though the payout ratio is actually less today, the yield is still much lower today than comparing it then to 2014. So you're not really buying this company for the dividend here in terms of yield. However, when looking at the dividend per share, we can see that the growth has been very nice here. So almost 10%-ish, for the first couple of years, and then it's picked up a little bit more here. So here's more than 10% actually for the most recent raise here. So, and this company also paid a dividend here in 2019, which is paid out for the fiscal year 2019, paid out in 2020. So even during the COVID-19 years, this company did actually pay out a dividend. So the board here for this company has a lot of confidence in its balance sheet, and it shows here. So investors looking for a steady and very reliable dividend here, this is a good company and a good example of a company that probably will pay their dividends even in times during stress. So yeah, for the dividend guys here, at least this is what the company looks like. Now for the CEO letter, and I think that the remark in itself was pretty weak because there weren't really that much of providing investors with how the business is doing in the future. So it just makes it really tough when they aren't adding portions here where they see where they have the challenges in the future, how the next couple of quarters is going to look like, if it's strong headwinds or strong tailwinds per se. I always appreciate when the CEOs are telling us, investors or speculators, that we have these headwinds, these are the issues that we're dealing with, that we want to drive improvements for. So kind of a weak letter in that regard, but again, maybe I missed something here in the letter, but there's just positive things here. Easier to recruit people, like new employees. Maybe it's because of many of the startups are struggling, so the good people from those startups are probably looking for more stable companies or something like this. I don't know, but unfortunately I couldn't really find anything other than just positive things. And positive things, CEOs are oftentimes very bullish on their own operations and so on, and I'm a little bit skeptic towards that. I much prefer managers being a little bit more conservative and telling speculators and investors about the risks of the company, and I think there weren't that much of this, and that could be the result of this being a great company, obviously, and we've seen great revenues increases and so on. So the company is probably doing pretty well, but I would have appreciated some negative comments here, a full section of these are our headwinds in terms of FX or whatever, but maybe I missed something. Maybe you can comment in the comment section if you found something. Now this is it for this video. I thought that this company had very exciting numbers. I mean, especially the gross margin here at 88% was kind of crazy. It's not that many companies that can offer those kind of margins. However, it is a software company, so you have to remember that, but still very good. The only negative things that I really saw here was the price, and they say that sometimes you have to pay up and cry once, but yeah. But even comparing it then to the past few years, the company is actually at much better prices, or the EBIT to EBIT here was at much lower multiples here. You know, it did trade as high as 54 times, I think it was, and now it was in its 30s, so definitely a lower price that you're paying today compared to just a few years ago. And yeah, and I really like, though, in a sense, that the business was such a diversified business, you know, that they had a lot of different business units and no single customer accounted for that much in terms of percentages. So very diversified, which I like. Anyways, thank you very much for watching this video. I hope you found it interesting. If you like it, please hit the like button below, and please subscribe to the channel, if you will, for more content. Thank you very much for watching. Bye.